Hello there. My name is Miles Pitcher. I'm the owner of Superior Lending. And today I want to visit with you a little bit about FHA loans and a debt to income ratio. You may have heard this term if you've been shopping around or done a mortgage before. Sometimes it's called debt or DTI, debt to income ratio. So it's not as complicated as it sounds. Essentially, it's a calculation that we use in helping to figure out if you can qualify for the mortgage. And let me explain how it works. It's one of the elements in qualifying. So we have specific guidelines that tell us what percentage of your gross income can go towards paying your new mortgage and the other monthly debts you have. So let's take an example. So let's say you have a monthly income of $4,000 before your deductions, before taxes or gross. And then you pay $1,200 a month towards your debts. We'll assume that your new mortgage isn't included in that. So that means your debt ratio in that case would be 30%. Another example, let's say that you make $10,000 a month, and between the credit cards, car payments, student loans, and the new mortgage, you're now paying $5,000 a month. That means that your debt ratio is going to be at 50%. So that's what we use in looking at qualifying. Just so you know where the limits are, if you look in guidelines, they're going to tell you 43, 45%. And that's typically where we find our conventional loans. But one of the things that we love about FHA is we can stretch our debt ratios a little bit higher. We can go many times up to 56% on our debt ratios. It just all depends on a few compensating factors, such as how much down payment you are doing, where your credit score is at, and then sometimes we can stretch that. It's one of the reasons why I love FHA so much is it allows my clients to get more home or qualify for more home. The other thing that's recently happened is FHA has reduced their monthly mortgage insurance premium. And you've probably heard about mortgage insurance. So it's in place on FHA loans. It's become extremely or a lot less expensive. And that helps our clients' debt ratios because we include the new mortgage payment in that debt ratio. So if you do the numbers, and we are happy to do your debt ratio calculations for you, if you find that your debt ratio is looking a little bit high, what can you do about that? So obviously making more money is always a great thing, and that's great. Ask your boss for a raise. But our favorite thing to do is to see a client who maybe has some credit cards, car payments, student loans to reduce down their debt. And maybe you have a super expensive interest rate on a credit card or a car. If you can get that down to a lower monthly payment, a lower interest rate, that's going to benefit your debt ratio. Some of the other things you need to be aware of in the debt ratio is student loans. Even though you may not be paying on your student loan, you're still in school or just out of school, we have to take an account for what the monthly payment will look like on those student loans. So just remember that that's going to come into the calculations. So other factors that we're looking at, and we'll cover some of these in other videos, is credit score, employment history, and your savings or how much down payment you're doing. So let me help you out if you have any questions on your debt ratios, but that should give you a pretty good intro and base of what we're talking about when we're explaining debt ratios. And I forgot to mention, you also need to include in an HOA fee if there is one on the property you're looking at buying. Thanks for watching. Let me know if my team can help you. Have a great day.